In this video, I'm going to share with you basically the exact process that I use when I try to trade the wheel strategy. I'm going to show you how I choose the stocks, what are the things that I'm looking at, what is the expiration that I like to choose, and basically the purpose of this video, and there's going to be one after, this is part one, and there's going to be part two, this is going to be a 2-video series. The purpose of those videos is to really take you step by step and show you exactly how I would take, for example, a trade using the wheel strategy. And it's really about, trying to be transparent and trying to show you exactly how I do it, how I choose the stocks, what are the things that I like to look at. So hopefully it can give you maybe some guidance on how you can use the wheel strategy for yourself. So as I said, I'm going to make that process in 2 videos because there are going to be a lot of things that we're going to cover. So maybe in one video is going to be too much information, so I'm going to put it in 2 videos. But before diving into this video, if you like this type of concept where I'm basically going to share my process from A to Z, then I'm going to try to make something a bit different here, like doing a 2-part video series on how I place a trade using the wheel strategy. Then don't hesitate to subscribe to my channel and liking this video, and don't hesitate to let me know also in the comment section that you like this type of videos. That's really the best way you can let me know that you appreciate this type of videos and that I should basically do more videos like this one. So as I said, I'm going to really go step by step. First of all, we're going to do a small reminder of the strategy, what is the wheel strategy, how it works, what is the purpose of it. Then we're going to go on and actually select a stock. And after that, I think we'll stop there, because once we will have chosen the stock, we will go on into the expiration and the strike, and that will be for the next video. But first of all, what is the wheel strategy? Let's do a small reminder. Maybe some of you have heard about the wheel strategy. It's quite a famous strategy, and I'm going to briefly summarize it so you can have a clear idea of what is the wheel strategy. So the wheel strategy is a strategy that is quite famous actually, and that's a strategy that, from beginners to quite more advanced people trading options, this is a strategy that everyone uses because this is very simple to understand. It's very processed and systemized, so you can basically follow like what we call a trading plan, really to the T, and having that strategy really on paper and following it is very useful, especially when you're new to options. So the wheel strategy goes like this. First of all, you're going to sell a put on a stock, and by selling that put, 2 things can happen. Either the stock goes up, and in that case, the put that you sold expires worthless. In that case, great, you just sell another put on the stock and keep going until the second outcome happens, your put expires in the money. If your put expires in the money, it means that you're getting a sign on your put. What does that mean, getting a sign? Well, when you get a sign on a put, once you sold a put, you have to buy 100 shares of the stock at the strike price. And you have to do it, you're forced to do it. That's the thing when you sell options. When you sell a put or you sell a call, if your option expires in the money, then you have to either buy 100 shares if you had previously sold a put and you got a sign on it, or short 100 shares if you had sold a call and you got a sign on it. In our case, the first step of the wheel strategy is to sell the put. And as I said, if the put expires worthless, then all good, you can just keep selling another put until your put expires in the money. In that case, you get a sign and you have to buy 100 shares. That was for the first part of the wheel strategy. Now, once you have been assigned on your put and now you're the proud owner of the 100 shares of the stock, now we can go on to the next step of the wheel strategy, selling calls. You're going to sell calls on the stock that you just got a sign on with your put and you just bought 100 shares. And the reason we're going to start selling calls against the shares that you just bought when you got a sign on your put is to what we call reduce the cost basis. Basically, to make it very, very simple without going too much into the details, all the shares that you bought, meaning that you spent money buying the 100 shares when you got a sign on your put, by selling calls, we're going to try to reduce the cost of those 100 shares by selling calls. And when we sell a call, there are going to be 2 outcomes possible. If, for example, the call expires worthless, then great. In that case, we just keep selling calls against our shares, and that's going to reduce the cost basis until the second outcome happens, exactly like in the first case with our put. If our call expires in the money, then in that case, we have to short 100 shares of the stock. But luckily for us, we have already 100 shares of the stock because we previously bought 100 shares of the stock when we got a sign on the put that we sold in the first step of the wheel strategy. So in that case, that's great. You just sell back the shares that you had previously bought. And hopefully, if you have managed to do that without having lowered your strike too much, you should be able to sell your shares at a profit. Plus, you have also collected all the previous credits when you sold the different options, so hopefully you're overall in a profit. So that's basically the wheel strategy. And to sum sum it up, there are several steps. First step, you sell a put, then two outcomes. Either your put expires out the money, and in that case, you just keep selling another put until the put expires in the money. And in that case, you buy 100 shares of the stock. Then you sell a call against those shares. Once again, two outcomes possible. Either the call expires out the money, and in that case, you can just keep selling calls and reduce your cost basis, or your call expires in the money. And in that case, you are getting a sign on your call and you have to sell 100 shares of the stock, selling basically the 100 shares that you had previously acquired when you got a sign on your put. I hope it makes sense. It's basically like very summarized, but it's basically what the wheel strategy is. And that's usually why the wheel strategy is actually quite popular, because it's quite simple to understand. You can really do it over and over again, and you can see that that's why we call that the wheel. There is some kind of process to it, meaning that you are going to repeat and then you're going to keep selling puts, and if it expires at the money, you keep doing it. And once you arrive at the end and you have been assigned on your call, then you can start the whole process again. That's why we call that the wheel strategy. So now that we understand what is the wheel strategy, what are the different steps, let's go into the real purpose of this 2-video series, placing a trade using the wheel strategy. So the first thing that we need to do before, even thinking about strikes or puts and calls is to first of all choose a stock. So usually, how am I choosing a stock for the wheel strategy? Well, there are different criteria that I tend to respect when I try to find a stock using the wheel strategy. I'm going to focus on different things. First of all, there's the liquidity. I want to trade a stock that is going to be very liquid, and not only at the stock level, meaning that, you have, for example, 5-10 million shares traded a day on the stock. That's great, that's liquid. However, I also want the options for that stock to also be very liquid. Otherwise, if you just have the stock liquid and you're trading the options that are illiquid, then it's not going to help you at all. You want the stock and you want the options to both be liquid. So how are we going to check that? To check the liquidity of options, you can use either, for example, the volume, or you can look at the bid-ask spread, or you can look at the open interest. All of those things are very indicative of how liquid options are. And to make you fully understand, because this is really important to understand why you want to go for liquid options, because just, going for liquid options for the sake of going for liquid options is not going to help you. I always want to trade liquid options, because the reason is, if I don't trade liquid options, I might find myself in a trade and not being able to, for example, get out of that trade at a fair price, and I'm going to have to move, for example, the price that I want to buy back my option at a very high price, missing a lot of the profits. I mean, basically the reason why you want to trade liquid things is not to find yourself in a position where you have to give back the profits that you made on that trade just because no one is willing to, for example, sell you or buy you the option that you want to either buy or sell. That's the reason why. And trust me, it can really be a costly mistake of not going for liquid options. So it's really preferable to go for liquid options. So as I said, the best is to go for liquid options. And as I said, there are different ways you could, for example, check if options are liquid on a certain stock. There's the bid-ask spread. So let me show you, for example, in Tesla, what liquidity could actually look like. So first of all, when you're looking at the options of a stock and trying to check if they're liquid, know that the weekly options tend to be a lot less liquid compared to the monthly option. So if you want to check how options are liquid for a certain stock, I definitely advise you to first of all go for monthly options. So for example, we're going to go for the August 2021 expiration, and we're going to check if those options are liquid. So the first thing that you can look at, as I said, is the open interest. Basically, the open interest refers to how many contracts are currently being held right now at this point in time. So the bigger the open interest, the more participants there are for that particular option. For example, here we are in the option chain for the August 2021 expiration for Tesla. If we look at, for example, the call side, so you can see that the call side is this window, and then you have the put side on the right. If we, for example, look at, let's say, the 600 strike that I'm just putting within that rectangle, you can see that there is the open interest in that column. And if we look at, for example, let me change some colors so we can actually see that. If we look at, for example, the open interest for the 600 strike, we can see that it has 1,090 in terms of open interest. So you can see that this is pretty liquid. And usually, to give you ballpark number, if the open interest is at least of several hundreds, then it's going to be fairly liquid. And another way of seeing if an option is liquid is to look at the bid-ask spread. And very simply think about it. If there are a lot of people willing to trade an option or a stock or anything, then the bid ask, meaning the difference between what buyers are willing to pay for an option or a stock and sellers what they're ready to sell an option or a stock for, then that bid ask is going to become very tight if options are liquid or if the stock is liquid or whatever you're trading basically. So if it's liquid, then the bid ask is going to be quite tight. If it's illiquid, then the bid ask is going to get wider and wider. And for example, here for the 600 strike, we see that you have the bid at 65.70 and you have the ask as 66.50. So here it's fairly liquid. It's less than $1 wide. I mean, it's quite liquid. There is obviously more liquid. For example, if we go into the SPY, and which is the S&P 500 ETF, well, that's the ETF the most traded, I think, in the world. So obviously it has very liquid options. And to show you what liquid looks like, well, liquid looks like this. If we look at, for example, the 414 strike, you can see that, first of all, in the open interest column, you have thousands and thousands of open interest for each and every single strike, which we didn't have for Tesla. And if you look at the bid ask for each and every single strike, I mean, you see that they are very, very tight. For example, for the 414 strike, you have the bid ask at 11.86 and you have the ask at 11.93. So that was liquidity for the options. And when it comes to the stock itself, as I said, we want to choose a stock that is going to be quite liquid. Well, I usually focus on stocks that have at least 5 million shares traded a day. That, usually that threshold is enough to have liquid stocks. And the fact that you're going to choose a liquid stock, you're going to usually have also liquid options that comes with it. It's very rare if you already go for a stock that is very liquid that you're going to find, liquid options after that. It's usually you need to have a liquid stock after, and then the options will usually also be liquid if the stock is liquid. So that was for the first criteria of choosing a stock for the wheel strategy is first of all liquidity. And as I said, I like to choose around 5 million shares traded a day. Then we go into another criteria that I very much like to use. I like to choose stocks for the wheel strategy that just got, like, for example, a bad month or a bad week in terms of the stock went down in the recent weeks or in the recent month. And the reason why I'm doing this is that if I can avoid, to be assigned on a put while using the wheel strategy at the highest strike possible, then I'm going to take it. For example, if we're using the wheel strategy on the SPY, I mean, that could absolutely be an example. I like to go for stocks that just got, some kind of a pullback, because the reason is, as you're getting assigned when you're using the wheel strategy, especially on your put, you're first of all getting assigned on your put, so you have to buy 100 shares. I might as well buy 100 shares at a lower price compared to the all-time high, so I don't get assigned at the highest strike possible. For example, we see that the SPY just went down to 414 in the recent days when it was at 425 before. When the SPY was at 425, I think it's a very bad candidate for the wheel strategy, because as you're getting assigned, you might as well get assigned on the stock at a lower price, so you're not assigned at the highest strike possible. And that's quite important, to not be assigned at the highest strike possible, because what you don't want to happen basically if you get assigned at the highest strike possible is to see the stock just plummeting just after. A bit like what the SPY is doing right now. I mean, it's not really crashing or anything, but what you don't want is being assigned at the highest point possible and then you have the stock just plummeting just after. And that's something that I figured out for myself, and that's something that I love doing. I'm going to go for stocks that just got like a pullback, like for example the SPY is doing right now. So it allows me to have this cushion of safety in a way. And then another criteria that I like to use for when choosing a stock for the wheel strategy is to avoid what I call crazy stocks. So what do I mean by avoiding crazy stocks? Well, when you use the wheel strategy, as you're going to have, skin in the game, you're going to have to buy 100 shares, you're going to have to be quite involved in it. I think it's very wise not to go, for example, for stocks like AMC or for example GME. I mean, you don't want to go for stocks that are just like skyrocketing then crashing the next day. First of all, if you're going for a stock that you don't mind owning, that is normal, for example, I don't know, like let's say XLF or anything like this, I mean something that is quite normal, something that is not going to skyrocket the next day like AMC and crash the next. I mean, you get what I'm saying. If you can avoid, trading the wheel strategy on this type of stocks, it's going to save you a lot of money. Because what you don't want to find yourself in, for example, in terms of trading the wheel strategy, you see a stock like, for example, RIDE. you see that it was trading, for example, at $10, and all of a sudden it just got crazy. And you look at this volatility, the stock was going to $30, then coming back to $13, then coming back to $30 over and over again. And now it seems that it just plummeted, then it's not going to go back to $30. I mean, I don't know, but you get my point. My point is to avoid, at least for me, to avoid this type of stocks, because I don't want to find myself in a position where the stock just loses, you know, I don't know, 50, 70% of its value just because it's too volatile. And I got a sign, you know, at the highest strikes possible, and now I have 100 shares of the stock that is worthless. That's basically the position that I don't want to find myself into. That's why I'm going to stick to stocks that are usually quite, I'd say, normal, that have like a normal volatility. They are not completely crazy. For example, if I look, I don't know, like Pfizer could be a good candidate, even though that one is quite volatile. But for example, XLF, you know, XLE, this type of stocks where there is not a crazy volatility like AMC or for example GME. But you would probably ask me, all right, cool, now we know a bit the criteria that I like to use. So how do I actually, you know, filter down, like how do I have a list of stocks that match those criteria that I just talked about, where I just was going on a rant, and how do I actually find some good candidates? Well, there are plenty of ways you could find good stocks and using those criteria. You could go into your broker and just start looking at the different stocks to see if there are some good ones that you'd like to trade following the criteria that I just said. Or you could do what I like to do also, is to use a screener, so you can actually find, you know, in a much easier way some good candidates. It's going to filter down and it's going to give you all the good candidates automatically matching your criteria that you want, and I think it saves a lot of time. Let me show you what I mean with the Finviz screener. So now we are in the Finviz screener, and let me walk you through the different criteria that I like to set on that screener, so you can also do it for yourself and find some good candidates for the wheel strategy. So the first thing to do is that I like to choose that optionable and shortable. That first of all ensures that the stocks that that this screener is going to show are optionable and shortable, as what these criteria say. Then in terms of price, I usually like to stay, for example, between $20 and $50 stocks. I like to choose this type of stocks that are between $20 and $50. This is usually my sweet spot when trying to find stocks for the wheel strategy. So let's say I choose between $20 to $50. Now, as I said, liquidity was also very important. I just said before that I like to choose stocks that have at least around 5 million shares traded per day. So what I usually go for is current volume, and then I'm going to go for over 5 million. So first of all, I don't know if you looked at how many pages we had before. We had a lot more pages than 7. So you see that now the screener is only showing us stocks that have, for example, options and that are shortable, that are between $20 and $50. We're also only seeing stocks with a current volume over 5 million shares traded per day. Then another thing that I like to use when it comes to the performance, I said that I like to choose stocks that recently got a pullback. Well, in that case, I like to go into technical, the technical tab, and at the top left corner, you have a performance filter. In that case, I like, for example, to go for the month, let's say month minus 10%. And it means that it's going to show stocks that over the last month lost 10% or more. So it's actually quite nice. You can obviously modify it according to what you want. You say that you could just say, you know, in the last month, I just want stocks that just had a pullback in the last month, or that lost more than 50%, 30%, 20%, or for the quarter, or for half a year. I mean, you see that you have plenty of different choices possible. But let's say that we, for example, stick to month 10%. So now we start having only 2 pages of stocks that are fitting those criteria. So you see that it's actually quite nice because it's shortlisting all of the potential candidates following the criteria that I just said. And nothing prevents you from, you know, as I said, modifying it a bit, trying to find what fits you. And personally, if I, for example, look at the different stocks, I'm going to, for example, go for FCX, which I think is a good candidate. As you can see on that little chart, it recently went from $45, $40 to $34. So let me jump into TestWorks to look at this more closely. So as you can see, FCX had a recent pullback. As we can see, it went from $42 to $34 now. And I'm tempted to, for example, use the wheel strategy on FCX. And now I think this is a better candidate, for example, compared to when it was around $44, because as I said, if I sell a put, let's say at the $44 or $45 per share, and it's an all-time high, and I get a sign, for example, at the 44 strike, well, I'm getting a sign at literally one of the points that is at the all-time high for that particular stock, for FCX, and that sucks a bit. I'd rather be assigned at a lower strike, so at least if there is a pullback, you know, at least I tried getting a sign at a lower price and not the all-time high. That's basically the goal of it, and that's why I like to choose this performance, you know, criteria in the Finviz screener. So I think I'm actually going to go for FCX for the wheel strategy. I think it's a good candidate. It's a liquid stock. You see that 46 million shares traded per day on the top right corner. And yeah, I think it's quite nice. And I think the options are also quite liquid. As I said before, as I showed you before, you can look at the bid ask, you can look at the open interest, the volume. And if we look at, for example, the August expiration, we see that there are actually quite a lot of open interest for each and every single strike. And I'm sure that if we go for the July, there are also going to be plenty of open interest, plenty of liquidity. Yeah, it seems like a good stock for the wheel strategy. So now that we actually chose the stock, I think we're going to end here. And in the next video, in the part 2 of this wheel strategy challenge, we're going to choose the expiration and we're going to choose the strike. And I'm going to explain you the differences between, for example, going for closer dated expiration, for longer dated expiration, which type of strike I like to use. Hopefully it's going to help you understand how I think and what is my thought process when using the wheel strategy. I hope you enjoyed that first part of this 2-video series. It's something new that I'm trying right now. I'm trying to make it a bit more, you know, enjoyable and trying to see what is my thought process. So don't hesitate to let me know what you think in the comment section of this video series, and if you have any recommendation. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.